A pleasure to be in Chennai. Last few months, I've been living in this city. So temporarily, I can also call it my home. And it's been a wonderful feeling being in this city for last few months. I'll continue to be here for a couple of months more for sure before I head back to Mumbai, which is the city where I live. I just thought it's a great opportunity to talk to you this evening as a part of this NBFC summit uh, as to how the whole credit is getting reimagined at the back of AI. And why I chose this is for two reasons. I was involved in building and leading pretty much the technology and digital practice at Kotak Mahindra Bank for 15 years. I was the president and chief digital officer of the bank till very recently. One of the first CDOs in this country across industry. And I've seen a lot change between 2008 till very recently. And now in my current role where I'm a board member on one of the banks, helping them build the next wave of micro lending, microfinance, finding bottom of the pyramid distribution model. And also I'm on a global advisory board of one of the Silicon Valley based Gen AI company called Instabase. Instabase is not in India right now, but having seen very closely the kind of work some of the leading institutions are doing in US and in Europe, large likes of Goldman Sachs, JP Morgan, Lloyds, plan is to see how some of those models can be brought and solve the population scale problems in India. So I think these are the two contexts that I will use. I know time is short, so I'll keep it very relevant. I know for all of you, those who are here. So three things. I think while a lot is changing, but I'll focus only on three things for today. When we look at reimagining the whole credit and lending business, I think we heard wonderful sessions on co-lending, and I'm sure during the day you would have had many more. Customer, credit, and collections. I know there are many other areas, but I'm not getting into that. And when we talk of customer, I think one of the biggest challenge for every single lender, be it a bank or an NBFC or a fintech, is how do you find right customer at the lowest cost? And the quality of customer, which leads to conversion, because none of us want to keep paying a lot of money to Googles and Facebook to find customers and increase our cost of acquisition. So CACs are high, and thereby ability to scale up organically is low. And thereby institutions look at other opportunities like cross-sell, co-lending, finding ways of getting customer at a lower cost. The second challenge is on the credit underwriting, because today we are only doing a financial statement-based credit, but like you heard, regulators are concerned. They are not saying don't go and write more credit, but they are more concerned about your quality of underwriting practice and is it more dynamic in nature. In the past, I have heard this, that, whenever there is an issue, every lender says, no, we did everything right, but still there was a systemic failure. And thereby, lenders expect you to monitor on an ongoing basis what is the risk on the book. Because if you have done probably underwritten a 24 months or a 30 months unsecured loan, given it to a customer, the challenge is what is the end user fund? Purpose for which the money was given, is it really deployed for the right purpose, or the money has got into something where the chances of customer repayment is low? What are the cyclical impact of various events that is happening around us? And thereby, is it creating a kind of a credit bubble? So I think the whole idea is how on the credit side, which is the second part, are you on an ongoing basis, not just at the time of underwriting, but over a life cycle of the customer's credit and risk, do you monitor it more effectively? And third, of course, is on the collection. It's very easy to distribute money, very difficult to get it back. And that's why I think when especially you're looking at going down to small ticket loans, that becomes the biggest limiting factor, because everybody was very keen a couple of years back to do a BNPL and a small value credit without thinking of how will you get the money back. So I think these are the three fundamental challenges, apart from, of course, many others. Now, what is changing through the back of AI? And when I'm talking AI, I'm more particularly keen on talk about the Gen AI. There was a time when we were all talking of AI across everything. But I think today, thanks to the whole LLM models around us, we don't need the deep learning, a lot of data, a lot of training period before you start to perfect your models. I think that is one fundamental shift that has started to happen when you reimagine your business around the whole Gen AI. I think the second thing is we are seeing a lot of unstructured data, which is not just the first party data that customers are sharing with us, but also the second party and third party data. Thanks to the whole personal data protection rules, thanks to the whole account aggregator based consent mechanism, and also there are new credit models that are coming by different third parties. For example, if you want to lend to a restaurant, what better way to find what kind of business are they doing on likes of Zomato or a Swiggy? But that data is today not available to you. So what you do is you only take data on the financials, and the guy does not have enough data to show you on just purely financials. Similarly, what kind of cash flows through the POS and receivables this person is getting, thereby building that cash flow projection. So moment you start getting a lot of such signals, you have to triangulate it. These are not static information. These are all dynamic information. Reading a bank statement and inputting it into a business rule engine was easy. You could set the kind of rules and it gave you a certain output, and basis that you took a decision of whether go, no go, or what kind of additional due diligence required. Moment you start building things which are far more dynamic, that's where you need the LLM models, because at the end of it, there are triangulations at all point in time, and the person who's either at the origination stage needs to clearly know whether this case will go through or not. No point picking up a file and later on realizing you can't disperse. Same thing when there is a person sitting, a credit officer or a senior credit folk. He or she needs to quickly analyze whether this case will go through or not. When you are doing a co-origination or a co-lending or are looking at any partnership through which you find right customer, all you today do is you just put your scorecards there. Your scorecard only tells you about what you know. But like I gave an example of Zomato, Zomato knows so much more that you don't know. Now, if you have to combine these two models, or if you have to work alongside a telco or a POS merchant who has a lot of information on, say, hospital, health club, beauty salons, now you want to start finding those as your point of acquisition. You need to find a model on which their data triangulates with your data, and thereby you can dynamically take a call. I think models like these today are possible due to this Gen AI. The other part of this is on the whole operations. I think this, as we start going through smaller ticket size, you just cannot afford to have your traditional high cost, high people operation overheads, because at the end of it, your cost of compliance will eventually only go in one direction. That can't come down. Your cost of collection, even if you want, you will not be able to bring down. Your cost of origination and your cost of operation and your credit cost, these are the only three variables that you can control. And thereby, if you can bring it down by 150 to 100 bips across your whole credit origination life cycle, I think you can get a much higher ROE and thereby can go and compete probably a ticket size lower than where traditionally you operate. So I think it opens up new market opportunity. Now, operations, one of the significant use case I've seen globally now institutions are doing is you get a lot of data, either they are financial statements, third-party information. Now a credit guy has to take a real-time call as to what do I do with it. Now with this query engines that LLMs provide, you only ask relevant information. You want a proposal to be generated, these LLM models can just generate a credit proposal. It can even figure out what specific things should you watch out for or additional information should you be asking for. So you are not completely eliminating resources, But I think by embedding it into the workflow, you are able to get a much better output, much faster turnaround, reduce the TAT and the overall cost of doing business. So I think fundamentally, collections, again, when I mentioned, collections is not about sending somebody on the field, but it's more about finding out who are likely to default. How do you embed your early warning system into your collection life cycle? Now, all these are pretty much possible. So as you think about it, I know I've run out of time, so I'll just conclude with this. Ensure that instead of getting into the fad of Gen AI and LLM, figure out how it embeds into the data that you have, especially the unstructured data, and starts to create value at each of these points. So thank you very much for having me here. I know I won't stand between you and the awards. So thank you.